to Kathy Wood. A special hello to Ed Finder, who had his 55th birthday yesterday.
That's right.
Rich Gula in the upper right-hand corner is my colleague who I've known from Brimberg days and is brilliant, and he will follow going over some charts. I'm going to quickly try to run through my element of the presentation and then have Rich speak. Rich worked under Dean LeBaron, a renowned billionaire financier who was a leader in quantitative modeling and indexing, and Rich ran billions of dollars for Bay Banks and worked under Ned Johnson and set up the chart room at Fidelity. So he has a good sense of where institutional money is and you know, how it flows and why. But he'll follow up after I do my thing. Right now, I'm going to share my screen so you can see my presentation, which also includes some charts. Does everyone see this thing that says March 2022 market overview?
Mm-hmm.
Okay.
Yep.
So basically, one of my observations, I'm 61 now. I feel like I'm actually, it's hard to believe, I still don't feel much over 26, but I've seen a bit. And, you know, I have seen bear markets, and I have studied all the greats who've looked at all the cycles. Bob Farrell is a guy at Merrill Lynch who was a chief market strategist for years and years and recently was quoted. And what he said is, given his history, and I think he started at Merrill as an analyst in 1956, he's 90 now. What his comment was is the S&P can go down 30% from in this move down. We're down about 17%. And my view is that basically we have had a huge move in the market, is a parabolic blow off top, valuations are high, and there's more downside risk. But for many of us, or, you know, we're not going to get out of the market entirely, you know, where to go. And another guy who I have a great deal of respect for is Jeremy Grantham, and he's studied bubbles and it's really cornered the market on being bearish. But, you know, he would say there's 50% downside on the S&P just to get back to trend line growth rates. So within that context, the question is, where do we invest? And just to kind of update us, as of through Tuesday evening, the NASDAQ was down 28% year to date. The S&P down 17, the Dow down 12. And I have a chart here of the S&P going back to the market bottom in March of 2020, and drew a trend line, and that uptrend line broke in January. And finally, you know, it's after one of these blow off runs that you are, you know, that cycle is over. I think we're in a bear market. I think the unique insight that I have come to focus on is that we are in an inflationary cycle. And when I, as a CFA, think about asset valuations, you know, I think about earnings, GDP, interest rates, and in an inflationary environment, a totally different group of assets outperform. And the problem people have psychologically is they want to go with what worked for the last 5 years, 10 years, whatever. So one of the things that I've observed, here is a chart, and it shows inflationary periods versus deflationary periods. It is my contention that we have entered a deflationary period, though I'm not sure whether you can see my squiggle. That index, which is measuring the S&P divided by the PPI, has actually turned down. Now, we're clearly seeing inflation numbers going back 40 years, but each inflation cycle follows a market crash, which happened in 1907. I don't think anybody remembers that. 1929, 71, not quite as defined, but clearly that was a top at the end of the wild 60s. Everyone remembers 2000. And I think right now we are at another bubble top. And now we're in the denouement, the unwind of that. And so another way, and this is through a guy who I have a great deal of respect for, Jeff Gundlach. He kind of identified this chart, and it's somewhat similar to the inflation deflation, where what you look at is the S&P and you divide it by the CRB index. And when you look at that ratio, basically from 1999 to 2008, you had an inflationary cycle and then a deflationary cycle from 09 to 2020. What I contend here is now we are in a new inflationary cycle, and what I have done is invested accordingly. And one way to really make a dramatic argument, and I kind of fell upon this, I'm like, well, what's a good example of an inflationary ETF? And that would be the energy, the XLE. So I looked at what the XLE was between where it bottomed in 1999 till where it peaked in that first inflationary period till 2008. And you had an annualized return of 22%. And during that period, the triple Qs annualized were down 3%. So you really had 25% outperformance had you faded the Qs, you faded tech being long duration assets. And that would be, those are the logical, the signals of an inflationary environment. Get out of long duration assets and get long energy or reflationary assets. The flip side, we saw from 2009 to 2022, and during that period, energy did nothing. We had a significant decline in energy from 2014, but then you've had the FANG stocks, and we had this massive move. And during that period, if you were in the Qs as opposed to the XLE, you outperformed by 16%. Now, anybody who knows anything about professional portfolio managers, they want to outperform. If you have 25% returns annualized for 10 years, followed by 16%, you will, that's staggering. But I think it's not a precise formula, but I think it rhymes with the proper approach. So again, going back to where we are in this cycle, valuations right now, if you use Shiller's CAPE ratio, we're at 29. We're currently at 32, which matches where we were in 1929. Now, Shiller takes a PE on the market, but he looks at it over the last 10 years to kind of smooth out for volatility. But my point here is if you actually look at this and say, yeah, I think he's right, we've got a peak here, it's going to be a couple of years until things really bottom out. So people who want to go back and buy the things that have worked well for the last 5 years, I think those guys are going to get burned, and you're starting to see it. You're starting to see it in all the tech stocks. But I think the fundamental problem is inflation. And something happened a week ago where suddenly you had Target and Walmart put up terrible numbers. And they were terrible because inflation wasn't just a problem for the Fed. And so interest rates are moving up. So the S&P needs to be valued at a lower level. What you saw was inflation started to crimp consumer spending. And as soon as Walmart mentioned that down here, the stock lost about 20% in a day. Now, that's a massive organization. I forget what the valuation is, something 250 billion, something in that on that order. And likewise, you were down, I forget what it was, 35% on Target. But the problem with Target is, again, inflation meant that their gross margin was getting because their cost of goods were going up. And so inflation it's real, and it's starting to impact the market in multiple ways. It's important in impacting its overall valuation, and it's impacting different sectors. And so just for the hell of it, to rock the boat, I was talking to Frank Longman, who works at Frank Texera, very sharp technician. And, you know, I heard Dan Niles mention this, but Apple probably is a short. Apple's overvalued. It's the largest company in the world. It's emblematic of the FANG stocks. And one, Dan Niles made this comment. He said, you know, in 2019, iPhone sales were flat to down. Then they went up to 70%. And people's spending habits during this whole COVID period changed. And so everyone was buying new iPhones and doing all this stuff online. Well, they're saying that they expect iPhone sales to be flat to negative by the end of the year. Well, all you need to do is be overvalued and see decelerating earnings, and you see what happens. So I think actually a fairly safe short is Apple. Most shorts are dangerous, and what we saw with meme stocks last year is it can be very dangerous. So one theme that I've talked about for a while is what we call the great rotation, and there are certain elements to it, but one element is we are in an inflationary cycle. The other thing that I've mentioned is in an inflationary cycle, the fundamental factors which impact asset pricing are different. And one of the things is that bonds do badly in rising inflation. And for my clients who've had bonds, I've moved them all into master limited partnerships, which offer high yields, and they produce income, because I deal with a lot of people who are retired and they need income. And the other factor to consider in the great rotation is moving out of long duration assets and looking at reflationary opportunities. So with regard, they're sort of hand in glove, somewhat similar, but there is a commodity cycle, a commodity super cycle that is ongoing. And let's take a quick look at, just to put that in context, the CRB. The CRB, Chicago Research Bureau index, is up 171% since its bottom in March of 2020. A lot of that is related to oil, but what's happened since 2014 is there has been so much price destruction in the energy space that you have not had the investing, the capital investment, so that there is the adequate supply, particularly conservation or ESG efforts have really made expanding oil, natural gas, any fossil fuels, even the cleaner ones, really prohibited. So we're not, while demand is going to continue to increase, you're going to see higher energy prices. Jeff Curry, who I think is probably the smartest guy on commodities, is saying we're in a super cycle. He was recently saying that their base case is for oil to go to 125, but really it could be 175 to 200. And that's not good, because those expenses flow through the economy. Now, one area when I really saw things wash out in March of 2020 is in the energy space. And ultimately, I ended up focusing on natural gas. I was buying a lot of closed-end MLP funds during that period of time. But Antero Resources, I went back, I looked at it. It was a stock that I started accumulating. It was at 95 cents on March 20th of 2020. During that week, there were actually MLP closed-end fund liquidations. And I heard about it. One of my colleagues was a former co-head of energy M&A at Citicorp, and he knew some people over there. And things were blowing up all over the place. And you had forced liquidation. And the best time to buy anything is when there's forced selling. And so that really is one of the bottoms I'm looking at. But to illustrate the cycle change here is Antero Resources closed yesterday at 41 or 42. So a stock in the last 2 years that has gone from 1 to 42, that has certainly helped a lot of the performance for my client. But related to them is more the MLP side part, which is Antero Midstream. They have about a 10% yield. And they, if you yield adjusted, are up 355%. Another stock that more in the last year I have started to accumulate is Tellurian, and they are building a export liquefaction facility, and it's run by Sharif Suki, who was a founder of Cheniere. And that has, it is a riskier proposition, but has significant upside potential. But thinking about Antero and going from a stock from 1 to 40, you don't need to have many stocks go from 1 to 40 to do well. One of the things that I'd spoken to some people who were concerned about Antero, and they look at research, for example, Morgan Stanley was very negative on it, and they had a debt wall. But actually, I mentioned a colleague who was co-head of energy M&A at Citicorp, and he said, "Oh yeah, I know those guys over at Antero. They're very sharp. They were investment bankers with me over at Lehman." And I'm like, "Well, it's good to know that you got a sharp management, but knowing something about investment bankers, they know how to put together very sophisticated models." And what I noticed was, even though it looked like it was going to go out of business and there were some people who were very cautious on the stock, they were buying in a little stock. The company was buying their own stock, and they were also retiring debt. And so, reflecting on that, I asked one of my quantitative assistants to do a screen, and I have it and I can send it to whoever is interested, of stocks which are reducing their debt, buying in their own outstanding debt, and buying back equity and reducing their share count. And since it's so hard, particularly in North America, particularly in the US, if you have surplus cash to reinvest, they're simply paying down their debt, and they're also buying back shares. And at the same time, prices are going through the roof. It is a winning combination. And I sent this list out to a bunch of energy experts, and I can talk about that later with others. But again, going back to the cycles, in 2014, you saw energy peak. Oil prices really started to turn south, and master limited partnerships, which I thought was an ideal place for people to put retirement money because of their nice, consistent pipeline toll road business models, that sector declined 87%. And, I point to here this March of 2020 period as a bottom, but that's a tremendous decline. I've been buying MLPs. These are pipelines. They have great yields, Energy Transfer, Enterprise Products, MPLX, MMP. And one area that I think is intriguing, and it does dovetail with some of what Bob Farrell was saying. He said he likes MLPs and gold and precious metals, is gold hasn't done anything for a while. It started to move up a few years ago, then it's kind of gone sideways, and more recently it's pulled back. And I think the pullback has to do in large part to the tightening or anticipated tightening by the Federal Reserve, because that firms up the US dollar, and gold tends to really do best when the dollar is weaker. But if I were to make a speculation or a speculative call here, I think there's a good chance that you can buy some gold stocks and precious metal stocks, and that what you will see is the Fed can only go so far without risking pushing us into a recession. And then you're going to have a weaker dollar, and money will start moving into gold. But in addition, I actually think that crypto will be the last speculative bubble to burst. And people have been saying, "Oh, that's a great store of wealth." I think it's emblematic of your typical wild-eyed speculation. Everyone loves it, but nobody can really understand it. Certainly I can. But I think that gold could be interesting. Two names I like: Barrick Gold Corp, Warren Buffett owned it. I like Savane-Stillwater. And both of these have recently pulled back. Some other reflation sectors that I like are food. There's a ETF, MOO as in Moo, which covers agriculture. That looks like that has been consolidating for a while, and now that is taking off in the last year and a half or so. And metals and mining, the XME, that has had a downtrend and now is breaking out on the upside. So basically, I think we're in a bear market. You're going to have rallies in that bear market. But I think that really the smart money, anybody who's really read the masters, it's once you see a big bubble and you have a big parabolic move, you get away from those stocks and you stay away from them. And I think that that is the call. Now, I mentioned Rich Gula, brilliant guy. He is now going to speak. That's his bio. I can send anybody this, but he's going to start talking about what's happening at Nordstrom and some other stocks. Go ahead, Rich.
You know, I always am reminded why I like you so much, Tyson. You're one of the few people that ever says nice things about me in my 73-year-old status as a senior technical viewer. One thing I would mention is that the two most interesting mega giants in finance that I had a chance to work with were, number one, Dean LeBaron, who right now would, if we still had Battery March alive and well, we'd be going through Cathie Wood's buy list as of February of 2021 when the fund peaked. And he would say, go find me the 1/3 that have some value and we'll equal weight them. And then we'll decide how much we're going to put into each of our clients' portfolios. Ned Johnson, on the other hand, was, I literally was hired because almost by default, everybody else seemed to screw up the interviews with a British guy named Craig Dinsel. And somehow I liked his British accent and he and I got along. And so for 5 years, I ran the Fidelity chart room after having worked at Battery March, but burning out of a lot of emerging market travel to South America and Eastern Europe and so on. And Ned sort of said three things always. One was that what charts do is remind you what actually happened in the past that you can't remember. Secondly, they tell you what is happening now that you don't like. And then he'd look at me and say, and they don't tell you a damn thing about what's going to happen next, except when they get really extreme. And Tyson and I have talked about energy and markets for through a number of cycles now. And we had very fruitful conversations in 2020 about energy stocks. I like to do it off of volume and volatility, and Tyson likes to do it about actually knowing what the company does. So he had some MLPs that did very well. And I tried to talk all my friends into Range Resources at $1 and failed as usual. And both worked pretty well, but for different reasons. Where we sit right now, and I've got Nordstrom up first because retail has suddenly beamed into the consciousness of the media and most analysts because of Target and a few other elements that have gone haywire here in the last month or so. I present it only because what goes down that way can go up that way. One of the things that both Dean and Ned Johnson understood was that market was symmetrical, but that down was faster. And something that went down a lot could very easily begin to spike upward if the same forces were behind it. And Nordstrom, which was under pressure for quite a while, suddenly acting that way. How do we move charts, Tyson? Do I just say next chart?
Use a next chart.
Oh God, that's too fancy for me. All right, this is actually the same chart that got.
Okay, now you're on.
There we go.
Expedia.
One of the things the market will tell you, so to speak. Ned also would say, whatever the market's telling you, you have to listen. And he said, then he would wink at me and say, and most people won't. But he said, if you can get it right 60 or 70% of the time, you'll have a great career. Expedia's decline kind of matches where one version of recession began to get into the consciousness of the market. Right up to that high that I've circled, you can see that there was a quick reversal, and that was the recovery economy that was supposedly going to take place by now in broadly in the United States. Please go to the next chart.
HSY, Hershey.
And Hershey's tells you that for defined benefit plans that stayed traditional, and I grew up with the old Pension and Investment Age magazine that now is, I think, just called Pensions, but it may be Pension and Investments. I get a free copy up to a point. Battery March had a very traditional relationship with Deere and Company, for example. This is the classic kind of stock they would have held for a long time. Depending on the weighting that they have to sit in a meeting with the dissonance of Cathie Wood stocks and Netflix and so on, and say, where's the bear? Because it's not in that chart. The tricky part is, what have you done for me lately, market? Do you sell Hershey here because it's coming? And can you rotate anywhere with a chance of a bounce? Or is it you're going to start selling the winners now and going into cash at, unfortunately, 2.7% on the 10-year rather than 3.2, which is a whole nother story. Next chart, please. This was
Lauder, Estee Lauder.
Estee Lauder's was kind of doing just fine, and then all of a sudden it hit the same probably earnings. I haven't dug into this because I still consult back to Fidelity, and I don't think anybody was asking about this. But anybody who will tell you that there was a top here that you could have picked off, and I would love to be on that panel and bring lots of examples in about that chart breaking down 10% and then reversing to new highs. That would have been a much higher probability expectation. But notice when it did it, it's doing it right at the turn. That looked to me like the robo people. You can pick on any firm that you'd like, but Schwab, TD Ameritrade, even Vanguard were probably running some version of an asset allocation program that suddenly turned on that kind of a name. Next slide, please.
Colgate-Palmolive.
And this is fun because when I first broke into the business, I got a job because no one else wanted to do options for a big regional brokerage firm in the late 70s. I dropped out of a doctoral program in psychology because I thought, one of my friends always reminds me, he said, the only person I know that would take greed over sex. And I said, well, I wouldn't be quite that definitive, but I said, greed is a lot more interesting and easier to measure in the open market. Colgate should look like Procter & Gamble. So why in the world is this stock having this kind of volatility? I would argue it's inside somebody's algorithmic programs. And they're doing baskets of stocks that relate to Colgate. They all probably have the same charts, and they have enough liquidity so that there can be long shorting against futures and options and ETFs simultaneously quite frequently. These are quick cycles. But there's no top in Colgate. So with all the volatility should be associating to a stock going down, and it's not happening. We've lost the charts there, I'm afraid. You have that's okay. We have my profile.
Telling me I need to go to full screen for a better view.
Oh, there we go. Yeah, next chart, please.
Spotify.
And now we're getting into something interesting that has flushed out, but is not being pursued at the moment. And you've lost the full screen again.
All right, I'm trying to make an adjustment, but I'm a little slow here.
It's probably Spotify management. It doesn't particularly want us to talk about this.
All right, we're there.
We go. Spotify is down 73%, but it just took a major hit recently. But notice it peaked with a whole another group of stocks. There was a top the day after Thanksgiving, and there was also a top in February of 2021. And various stocks that could probably end up in the Cathie Wood universe. Some of them carried forward, but eventually they all have been taken down. And please go to the next chart. These, by the way, are Battery March, why aren't we buying this kind of ideas, if a firm like Battery March can still exist in the world. And this is Cathie Wood. And I watch her YouTube presentations all the time. She's terrific. And whether she's made enough money off this already and has legal protection, so nobody's coming after her. And I hope not, because it should be, prospectuses are so long right now. The option prospectus is 90 pages long right now if you go to Fidelity or any of the firms, and it's the standard CBOE. So I wonder what the prospectus for ARC looked like at the time the money was really flowing in. What's interesting is that when you see these huge surges in volume that I've got the second circle around, that's generally the buyer's entry point for those who are highly liquid and are willing to risk something and buy a basket. You got to equal weight all your ideas. But this would definitely be on the list right now. And I was fully functional as a technical analyst and consultant for the 2002 decline. So I know what they can do to $1,100 stocks, which is take them to $50. So there's no guarantee here, obviously, that this is a buy, but somebody has now stepped in for the first time. Next, please.
Exxon.
And then we're back to our friends over at the Deere pension plan, hypothetical Deere pension plan, because I haven't talked to the Deere people in many, many years. And but they were one of my favorite clients. They're very sensible guys who and ran a business that you could actually understand. Notice that Exxon, from that low, had probably been sold out by the ESG movement that dominated almost every major university, and endowments as well, other endowments. And I don't know whether sovereign wealth funds talked a good game and bought the stock, but somebody did. You don't create that kind of an uptrend with just a knee-jerk reaction to being oversold, which is what you'd be looking for in the ARC chart first. That doesn't look to me like a trend that has Estee Lauder kind of risk. It looks like it's quite sustainable. And as you do the broad universe, I always do it on market cap, because I know that the great fiction about the best mutual funds was always that although Peter Lynch had a great reputation for small cap finds, large firms, once they own 5, 7, and 10% of a stock, are now really reluctant to own anymore. So market cap inside of energy was very key, and basically medium to small investors had the huge advantage coming off those lows. Next slide, please. My only problem with the inflation interest rate argument is that the 3.2 for the US 10-year didn't hold very well. I've been trading futures for about 20 years now, occasionally successfully, but without just destroying anything, which usually means it's sort of like batting 300 in baseball, which if you do that as a manager, you lose your fund and then you get in the Hall of Fame in baseball. Futures, as long as you don't lose all your money, 20-to-1 natural leverage is a very friendly kind of circumstance. But these global yields are basically going to take folks back into the US. And that's where the dollar strength to some degree is coming in. And if you can get enough equity market chaos as well as macro chaos, which is already there, I suspect that the 10-year at 2.7 is going to be just as interesting at 2.5. Because do you really want to make a choice between 2.5 in the US and 2.88 in Italy? Nothing else is really close to that. Next slide, please. This was the presentation. If you go to the CNBC website and you look under the early morning show, it's on from 5 to 6 in the morning, and Brian Sullivan is the host. And if I wasn't trying hard, I'd be able to remember the name of the show. On Friday, the 20th of May, I've got it on in the background. And all of a sudden, up comes a guy who's basically saying that the entire drop in Target and other stocks that have gone down in the aftermarket is completely, well, rigged is probably too strong. It's legal, but it's not accessible to the normal regular investor at all. It is, it's entirely manufactured by larger firms. I won't mention the firm that he mentioned. You'll have to watch the, it's about a 7-minute presentation. The essence of it is that there's an exchange of packets of stocks, if that's the right term, with an ETF that included Target. Then you took and returned something that was heavily weighted with Target, because all that's pretty transparent. There's then a sharp increase in puts, and then the pressure on the stock is met because of a somewhat obscure but very well-known rule among market makers that they have to make a market all the time. You can't say not now after 1 minute. So they are able, if I have the presentation correct, then please go see it, and I'd love to get a transcript. It's naked shorting in the aftermarket, where there is very limited access for most investors. If you go to the next slide now, you'll see this is the guy. His name will also appear. I didn't figure it was wise to show that in something that that Tyson might publish, but this guy had done his homework, and he had this down, and Brian Sullivan was entirely attentive and gave him about 7 minutes with minimal interruption. The only other person that ever gets away with that is Leon Cooperman, but that's because nobody knows how to interrupt Leon, and also because he's usually right. Next slide, please. There we go. And now this is a week later, you have Snap, and exactly the same thing happens. After the market closes, how in the world can you begin to take those kind of percentage drops in stocks that are well analyzed? And in Snap especially, it had already been down quite a bit. So this is the ETF interface with derivative people who lost their jobs in mortgages and then reinvented themselves, are out there somewhere. And I think these people are well funded, and one of the comments from the gentleman that made the presentation on the 20th, that he had talked with several entities that, let's say, suggested that 70% of their profits come out of these kind of forays, not out of just regular shorting and buying over the course of 250 market days, which the rest of us have to face. So if that's the hard part about being super bearish, is that if you can do this on the downside, you can do it on the upside. And so what would that do to a fully oversold market inside of Cathie Wood stocks, which are going to be very illiquid on the upside? And they're going to have a lot of short interest on top of any given name. Okay, I think we've got 1 or 2 more slides. This is the market since for 1 month on I think it's a 480 minute. And you say, well, why do you do that? If you do futures for about I would say 200 sessions, so that doesn't mean you might do it in a year, but you might not. It will become incredibly apparent that there are 3 trading sessions that are very, very dominant inside the futures, the liquid futures, especially equities and the US Treasury, gold, and oil. There's an Asian that begins at around 6 p.m. There's another one that begins at 3 a.m., which is basically dominated by Europeans. And then there's a US that begins kind of at 8 kind of overlaps with the Europeans. The worst declines in the US happen when you have an Asian rally and a European selling, because I think that the entities in Europe are using our futures to short their market. And you say, well, what's the correlation? I said, it doesn't have to be perfect given how much stronger the dollar is than the euro. So they're probably they're betting on a currency kick as well, and much better liquidity in any instrument they can find in any of the futures in the Eurex. I've tracked the Stocks 50 for a long time, and that's the only liquid equity futures contract that is tradable. But while we've been talking the market down, it's come down. But go to the next slide. We've also been talking interest rates wildly higher, and that's not what it looks like. Nobody stepped in and has begun to buy the 10-year treasury. I think it's probably short covering, but you've done 50 basis points now, 320 to 270 intraday. So there's, if you take the data points of where did stocks peak, what's down a lot, and a lot used to be 20%, now it's more like 60 to 70, thanks to the dot-coms. And then look at the interrelationships. Go to the last slide, and this is a plug for a book that I've been recommending for a long time to folks. You can only get it on Amazon, or there's a very good book website called the Libris, ALIBRIS. Next slide. This was written in 1971, and you throw away the chapter on gold because it was a fixed gold price back then. If you read this twice, you'll realize that you've got to take a multidisciplinary, multi-factor approach mentally. Whether you can do that statistically or not, that depends on where you are. And most of the technicians work in silos. If I gave them this book and then asked them, and I rated them on everything that's required for you to follow this, most of them would get C pluses, maybe an occasional B. But I'm not giving myself an A. I just had to do quantitative stuff for 10 years for Dean LeBaron, where we included price, but we also did it against book value and book value inside of a historical context. That's how emerging market funds were built off that. And they worked very well. So to wrap up, if you put on a chart of the S&P and the NASDAQ from 2020, March, end of March, April, you're down about 33% on those indices from the peak, and down 50%. Let's see, I think it gets you to 3410 or something like that. I had it in my, you can calculate that out yourself. But the 50% bear market is a pretty tricky target. 3450 would be down 50%. And I'm not sure that you're not going to find some serious support to come back in selectively. So it's going to be hard on a rotational basis to get indices down there. But everything, you could just beta adjust. If Procter & Gamble goes down 30, then NVIDIA goes down 50, and Snap goes down 70, and there's some stuff out there that's going down 90 and not coming back. Anyway, you are at a point where you're fighting your way into a low right now, and Tyson and I have discussed this. The worst case would be a rally to something like 4,400. If it goes up too high, then the history that you learned in 1973 is going to come back into play. Now you've got a lot of downside, a lot of air into the market. On the other hand, if this rotates, there's lots of shorts. Longs aren't going to be easy to come by. But if the 10-year treasury doesn't keep going, then the last point is that my first job at Putnam, one of the managers was a guy named Jerry Jordan, and Jerry was one of the best traders ever. And I thought he was just good technically, but he had mastered, quote unquote, the Fred database from the St. Louis Fed. And he told me years ago, he said, if no matter how hard your inflation numbers look, if you have no velocity, the Fed is going to worry about deflation. They're going to worry about lack of movement inside the organized system. And there's no velocity still anywhere in those charts. Anyway, thanks Dyson for the opportunity, and any questions are fair game afterward.
All right, so TY, we had something on the treasury here, was your last chart. Do you have a comment?
If you take out that yellow, the magenta line there,
Can I?
somebody's really beginning to push on it, regardless of the macro case. And you're going to be, there's someplace in here, there's a huge short covering. There's probably some already, but none of this looks to my old future's eye as anything more than somebody buying into it. Some short covering probably. Could also be funds that have gotten it wrong and are getting redemptions and they got to cover their shorts. That's out there right now.
Well, I'm going to interrupt you as we
Yes.
wrap this up and say that, and stop sharing. To me, what the big issue is, look at inflation. Anybody who understands basic monetary theory or what the Fed does, everything I learned was you need to raise interest rates above the inflation rate if you want to bring inflation rates down. We clearly are dealing with an environment where there are supply chain issues, so some of that can get figured out. But I don't see how interest rates don't go higher, but I think frankly, the Fed's in a box. That's why you need to have kind of, where can I go? Where can I invest in with an inflationary backdrop? And, that goes back to these reflationary ideas, that include metals, agriculture, energy, MLPs. And I think that's the play. And I showed that list of energy stocks with stocks that were being bought back and retiring their debt. And I shared it with one guy. He said, I don't want to get into them here because we're very late cycle and you're going to get a break in price and all. And he also, after buying 200,000 Antero at $1, sold it all at $4. I held on to 40, though he's a lot smarter than me. But my thought was, before you have that price break, you're going to have to see a hell of a lot more production domestically. And so it is dangerous when you buy stocks that have these big runs. But, these stocks fundamentally are still very cheap. And I love the idea of selecting a sector that makes a lot of sense, and then doing a scan where maybe you're turning out those where the activity is such that they're buying back stock and reducing their debt. I mean, that sounds like the prescription for a pretty bulletproof portfolio. I haven't done it on these other sectors, but that thought has crossed my mind, and I'll try to put that together. Now, does anyone here, we have...
Yeah, I mean, I looked at your list, Tyson. Now I'm not seeing it per se. Let me try to pull it up. But the ones I picked off that were, I always follow PXD, Pioneer. And because I know the Permian well, just from, starting with the oil shale boom in, 2013, era. And, they're doing fantastic. Their cash flow is amazing. Their dividend yield is off the charts. I bought them back in November. I started loading up on energy stocks that I was comfortable with back in November, right after the Copenhagen climate change conference, which is kind of funny, because I'm into sustainability and I write about the energy transition and I watch, ESG type behavior with capital flows relative to oil and gas. And so I kind of arbitrage between those two spaces, green infrastructure, renewables, oil and gas, and all things sustainable. So that's kind of what I do. And I definitely, you know, right before the Russian invasion, I kind of loaded up on some gas weighted oil and gas stocks like Coterra, Tyson. I like their asset base. I tend to look at the production in various basins relative to oil and gas and the players and see who's doing what and how the flows are. I kind of watch some of that, like the asset base issues. And then you can look at the MLPs connected to those players that I find, you know, that I understand their business. I know their management, you know, I know how they think, and I trust them. I mean, I've explored Pioneer for, you know, 15 years, in earnest, 10 years. So, and they're kind of, in my mind, a bellwether, you know, they're my bellwether of the Permian. So, and I also like some Marcellus players for gas, you know, just because of its potential. And we know that in this energy transition world, natural gas is going to be used more and more. And especially with what's happened with Russia, that's kind of brought that to light. So that's just kind of what I'd say, you know, on that level. So I have a real different way I look at things, and, you know, fundamentals with a lot of nuance and a lot of flows of different things, capital and trends and production and pricing and geopolitics and all that. So that's my take.
Well, I agree. And I would say that, you know, I've had people very much wanting to do the right thing and not wanting to pollute, and I won't buy a coal stock. And, you know, I think that natural gas is the most logical transition fuel right now, and to own those right names in the natural gas space makes sense. I think LNG is a beneficiary. The reality of it is, if they really wanted to stop climate change, they'd shut all the coal production in India and China and substitute it with natural gas. And then you would cut carbon emissions by half from the greatest polluters on the earth. But they'd rather, there's another strategy at work domestically. But
Tyson,
yes,
I have
Go ahead.
I kind of have a question on this
Go ahead.
whole, what's going on. What I just heard, you know, really from Jennifer was kind of the first real focus on the fundamentals. To me, trying to figure out what's happening, looking at the charts and trying to figure out what's behind it, and trying to figure out why a tech stock that never had any earnings can't go down 50% or 90%, because there's no way, there's no floor of fundamentals under them. It's all in your brain. And so I don't know how you can ever feel comfortable that they won't go down to zero, as kind of was talked about a little bit earlier. But my feeling is this: on all of the stocks that you're talking about, the energy stocks, doesn't it depend upon, so like, it's not only natural gas, but is it in the Permian? Is it on, are they in the right areas? Is the regulatory climate going to allow them to do stuff? I, for one, won't buy anything that has an ESG name on it. In fact, my portfolios all come with the rule, nothing that touches on ESG, and no companies that do DEI, any of that stuff. It may call me a contrarian, but I think those are all smokescreens for doing bad things to the economy. So, I mean, why aren't we just talking about the fundamentals? And we don't know where, for example, natural gas and oil are going to. And to disagree a little bit with the last thing you said, no, they wouldn't close down the coal plants and put up natural gas all over the place. They mostly put in nuclear, supplemented by natural gas. But
True, but I'm
it
not
does-
smart enough to pick the next nuclear
it-
technology to back.
Exactly, and it in a sense doesn't really matter, but it gets back to the fundamentals. Why aren't we just looking at the fundamentals? Now, we don't know if energy will have the capital in the future, like you've all said a bunch of times. If everybody's looking down at the industry, maybe they're not going to put a lot of capital into it. But maybe that's a good thing at the end of the day. It just means that the prices are going to have to
And,
go
and that,
higher.
and that's why these companies are buying back
And
their stock. and retiring
So
their
I
debt.
guess my question is, why aren't we only talking about the fundamentals and the specific fundamentals of the specific companies in the specific industries?
There's a limited amount of time. I could go into it, but I will say this about Antero. The analyst who wrote about it originally that I keyed off of pointed out very succinctly. He said the Utica and Marcellus, these are newer shale developments and are very rich and very heavy on the liquid side. So from that standpoint, they're really not constrained. And I would also say something else with regard to restrictions, governmental, there's sort of a scarcity play and that ties into master limited partnerships. You can't build new pipelines very easily. In fact, so why not just buy the companies that have good cash flows that are already in place instead of worrying about who's going to build the new one until there's a change in attitude out of the EPA. But anyway, though I wouldn't say that I haven't given consideration to those factors, but if you know me, I can just talk and talk and talk and everyone will go to sleep. Jennifer, you look like you want to say something.
Yeah, I was just going to address something you said about nuclear, because I do look at a cross section of energy sources, because, we're talking about the energy mix, right? And obviously nuclear is if there's going to be all this electrification, you need base load, and nuclear power is, it provides the most, net zero base load that exists. And there's a stock, I think it's CCJ. I put some money into them. It's a uranium type play. And also Fluor, I know, does FLR, infrastructure, but they invested in small scale nuclear technology. I was just at a conference. It was actually all these innovative firms like ocean wave energy and cold fusion and all of it. I mean, anything that's new, I was, there, and it's really cool stuff. And I got to moderate a panel, and it's all happening. It's all happening. But the bottom line is, oil and gas represents roughly like 85% of our energy source right now. And I think a lot of the players are trying to produce oil and gas more efficiently with less carbon. And that's one path. So there's all that potential for tech to sort of come to the rescue, but I think a lot of the big players are going to be buying up the tech firms that are going to do that as well. So I think you just have all these dynamics with, location of resources, users, producer nations. We're a top producer, we're a top producer, we're a top consumer. So we're where the action is, Russia's in there, but they're in the toilet. Oops, sorry. Don't want to say that publicly. But I mean, as far as, what's happening with their reputation as a producer, right? So there's just a lot of, factors. I could go on and rant about this, but I'll stop there.
Just a very interesting, when I was a freshman at Stuyvesant High School, many, many years ago, one of the top science high schools, if not the top in the country.
Still is.
Science, it still is, until they screw it up. But the first thing in the first day that the science teacher said, forget about plastics, forget about anything else. If you want to really make a name yourself in science, cold fusion.
Mm.
And we are now dare I say, more than 50 years later, and we're still saying the same thing. But I'll tell you, I still have the same hope I had when I sat in that class, because I do think that it will save us all if we could ever get there.
Yeah. Yeah, there's some guys on the West Coast trying to crack that code. And I haven't done my due diligence with them, but you know, it's very
Oh.
interesting.
I'll tell you something else that was very interesting in the 80s, maybe even the late 70s, because I was involved in natural resource plays, you know, people doing wildcatting and stuff like that. And they were always talking about this shale stuff. And it was a company called Oil Shale Corporation and something or Oil Shale, these two companies that were kind of the darlings, and every once in a while shot up in price and whatever. And it just seemed that it was just a step away. And I forgot when it changed from way into the future to an incredible part of today. But it really did happen. And I every once in a while wonder what happened to those specific stocks that everybody was playing with all those years ago. And did they ever make it, or did they die before shale took over?
You know, I'll just say one thing, Tyson. Since we spent so much time on energy, I'll ask a question. Are all you guys familiar with the work that Lee Goring and Adam Rosenzweig do? Because if you're not, you're missing the whole play. Any responses?
Well, I've read the report, and you've also referred me to them.
I
but-
know that, but has
And
no
what's-
one else?
What's the name of their firm?
It's Goring and Rosenzweig, something like that. Lee Goring and Adam Rosenzweig. It is the definitive Bible on, I mean, they got me involved in energy prior to the Russian invasion and blah, 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 blah. The fact is, this is a major long-term play. It's crazy. I mean, thanks to Tyson, I have the AR. I probably paid all of 2 for it instead of 1, maybe even 2.5. What is it now, 44?
I don't know. I didn't look at it today.
At any
But
rate,
it's over 40.
but the point is, this is such a major, when you go back and read this and you understand the limited return on what this ESG crap, as Alan didn't have the courage to say, but when you realize the limited return on
Thank
it, by
you.
the time you put in the backup systems that require it and the increased cost of money and energy now in order to make all these devices, number one, this is nothing that should be left to a government to allocate. We've never gotten anywhere when our government allocates them. But more importantly, you'll see, and China and Russia can't get rid of, excuse me, China and India can't get rid of coal because they don't have the money to replace it. Actually, ARLP is something you should all own, so write it down. And it's, you know, it benefits from natural gas. So the top coal producer in the country in terms of quality and profitability, and whenever natural gas goes up in price, the price of coal goes up in price, and they pay a big dividend because I'm an old man and need the interest. But the point is, this thing is going to go on for some time, and you're just missing a wonderful intellectual experience if you don't go through. And you know, they're very friendly guys. They got another write-up today, and or whenever it came out in Grant's Interest Rate Observer. It's not as in-depth as the previous one he had, and they're going to be speaking at his conference. But it's just, which is why I beat Tyson up on it. It's a very exciting thing that they're doing, and to the extent you want to play in energy, I think that's where you got to be.
I've read the research, not all of it. And what I can say is that very much they have talked about the historical cycle and it coming back. And they have very good analysts. They do serious, deep research. I think that they worked with Chilton, or one of the guys left
Yeah, they
Chilton.
used to be with Rich.
So, you know, definitely pedigreed experts in the space.
Oh, let me
But-
just say this,
but
Jennifer.
Go on.
They have, get their stuff, they have analyzed, I mean, their whole thing was going through all the shale plays and understanding, as you know, they were doing top loading or whatever they call it. And the only stuff that's really been coming on is the uncompleted, you know, which they've been completing, but they just went through and they showed how our shale productivity was going to go down. And then when you have the federal government under these baboons, you know, further eliminating the ability for them to grow. I mean, cutting off pipeline development and what have you. But you would like it very much because of your familiarity with the basins.
Now,
Yes.
speaking of the government getting involved in this stupidity, God help us to what's going to happen to the bottom line of all these companies if the SEC regulations go through. Hopefully they'll be able to stop it in court, but you won't, it's going to kind of quintuple the cost of compliance and accounting fees, and it's going to hurt everybody's bottom line, especially the smaller companies.
Go ahead, Jennifer.
No, I was just gonna say, in talking about the shale plays and the productivity, Scott Sheffield talked about, I don't know if it was 2 earnings calls ago, but he discussed the prospects of different shale players' potential, and you should have a look at it because Scott Sheffield's on the ground. I mean, he knows all this stuff. I cut my teeth with a financial economist who was an energy expert who, you know, advised OPEC and stuff. And he sort of trained me on the fundamentals and pricing and economics and geopolitics and money flows and shale dynamics. And I mean, I started in the Barnett Shale revolution, you know, wrote one of the first articles back in 2008 with all the players, the history, all of it. And then I pivoted over to the oil boom, you know, which started in the Bakken, and then the Eagle Ford, and then the Permian really just, you know, knocked it out because of the production capacity. If you look at the EIA's drilling productivity reports, you know, you can kind of have a look at, you know, how the production is changing over time, the history of it. All that analysis is there, you know. Yeah, so you know, I hate to say it, but I don't read much of people's stuff anymore. I do my own research based on my own, you know, watching a lot of different fundamentals, watching the players, watching the flows, using my intuition, you know, sensing where the wind's blowing, and, you know, and I'm
Jennifer, I
golden.
can only say
Yeah,
that if you will take the time to
yeah.
read their stuff, and then if you find it, that if you don't think it was an incredible help, I will buy you a delicious dinner.
No, I definitely, I mean, it's not that I don't read people's stuff. It's just, I try not to put too much noise in my own analysis, you know, because there's so much noise, but
Okay, well-
I definitely will read, you know, the odd thing here and there just to test myself. Right. I mean, I don't have the gospel. Yeah. Just to back test myself a bit or front test myself, you know? So yeah, no, I'll definitely have a look at it. You know,
Yeah.
I've
And I
listened
don't
to
think-
Jurgen. Jurgen's great. You know,
I agree.
mean,
He's different. I mean, wait till you see what these guys have done.
no, I understand what you're saying. Yeah, I know there's differences for sure. Yeah. But I got to cut out, guys. So
Yeah, I think Jennifer, thank you.
yeah,
Thank you
sure.
for your insight, Walter, Alan, everyone,
care.
Rich Gula.
Thank
Yeah.
you, Ted.
Scott,
Thank you,
Stephen,
everybody. Thank you,
Terry.
Tyson. Happy Memorial Day.
All right. Take
All
care.
right, good point. Okay. Onward and upward.
Okay, bye-bye.